Four things every business should know before scaling. Do you have the answers? For my work with clients across industries, it didn't matter if it was professional services, SaaS, food manufacturing, etc. I realized there were four main metrics that told me if a business was going to struggle or if they were going to be healthy. So today we're going to cover four things: cash flow, margins, revenue, and growth targets. We're going to look at these from a fairly high level and kind of understand what you can do and what to look for to make sure your business is sustainable as you scale. So, first one is cash flow. So, the way I look at cash flow is kind of like this diagram. You have starting cash where you collect revenue from your clients. So, if you're in professional services, yeah, it's pretty simple. You invoice them, money comes in, or if you're in subscription, uh, you charge them automatic payments come in on every billing cycle. So it comes in, then you have all your expenses, comes out, so you have your ending cash. Simple. However, sometimes you don't know how leaky the bucket is in terms of cash coming out, and you don't know the consistency and predictability of cash coming in. Sometimes payments are late, sometimes there's failed payments, failed credit cards, and so there it ends up being a chokehold at the final funnel, which is the ending cash. So it's really important to have a good grip and really understand on a weekly or monthly basis where the cash is coming in and out and the frequencies and what it really is, other than looking at your bank balance at the end of the month. The second one is margins. So, yeah, margins. We're talking about margins, everyone. So, margins, there's a lot of different ways to calculate it, but the one I specialize in more and the one I focus on is contribution margin. And what contribution margin is, I know we're looking at almost like an accounting textbook, but it's basically the difference of or what's left over between your sales revenue and your variable costs. So the way you can think about it is each dollar of sale, how much of that um, is left over after you factor in all the expenses needed to make that sale. So if it's a software business, you want to think about the servers and hosting costs, and maybe even um, the extra time it takes to close a customer. Uh, so maybe your sales and marketing automation software. Uh, so basically, any incremental costs that it takes to produce that extra revenue, that's what goes into your variable costs here. And if you are, let's say, a service provider or in professional services, you're probably thinking about in order to service this extra client, how many hours of labor or admin software or user accounts that you need just to set them all up to get to basically what's called a contribution margin. And like an example here, so for example, if you're selling, let's say, a product, let's say you're selling sunglasses, right? So uh, this month alone, you made, it's pretty good for a company. So let's just say on an annual basis, you had 500K in sales and you sold 10,000 pairs of sunglasses and it cost you 250K to make it and 200K to ship it. So your leftover contribution margin is 50K and kind of the contribution margin per unit is $5. So that's kind of the accounting way of looking at it. But from a business perspective, it means that every one unit sold, you get $5 of incremental, um, basically profit or revenue in your pocket. So that's pretty good. Um, and those are things that I think about when looking at how repeatable a business is, um, how how much leverage there is to improve the business model, and whether it's sustainable long run. Because this could change over time, right? Like your contribution margin, maybe uh, another pandemic happens again for this example for sunglasses. So you have supplier delays. And so the cost and shipping it takes to produce this goes up. And so if this goes up, then your contribution margin goes lower, or maybe there's more competitors in the market because they can produce it at a lower cost. And so um, these are all the different levers that I would pull to try to understand how sustainable and resilient your business model is. So next we're going to talk about is revenue. So it's pretty obvious what the different ways you can get revenue, lead gen, marketing, etc. We're not going to talk about that from that perspective. It's more around um, just understanding how consistent is your revenue. Like in the example we were looking at, um, this is the lump sum of revenue over a year in this example, but maybe it all came during the summer months because that's when people want the product more. In the winter, there's less sales, and so the consistency is not there. And if your sales aren't consistent, you have a lot of seasonal ebbs and flows, then maybe even if it's a consumer product and if it's sort of like a fad, then it might not be sustainable long run. So these revenues might dip, and you might just have traction for really good 12, 24 months, but may not be able to keep that going forward. And if that's the case, then the lack of sustainability is gonna actually go back and affect your cash flow. It goes back to step one because you're not able to sustain the revenue. You're going to have less dollars coming in, but you're not going to know when that point is. And so maybe you've spent too much on inventory, or all your um, all the variable costs to produce it, and maybe you've added a lot more fixed costs on top of that, and so it's just choking up the amount of cash that you're gonna have to pocket at the end of the day. So that's a factor to think about. And another thing to think about in revenue is maybe you spend a lot of time chasing revenue or other high vanity metrics, but it comes at the cost of trying to get it. Like maybe legislation wise, you forgot about some things. Like in this example of Silicon Valley, basically they were chasing users slash revenue at the cost of not understanding the Child Protection Act. And so every user they brought on, they're actually violating terms of service, and they're racking up more and more fines as more users sign up. So at the cost of chasing revenue, um, yeah, this could also happen. So you want to be thinking about how sustainable it is, and what levers you can pull to make that as consistent as possible. And the last we'll talk about is growth targets, which kind of tie hand in hand in revenue. So once you figured out how to make it sustainable or at least consistent, you want to figure out what metrics, what growth targets you want to hit. So on an annual basis or a 3-year basis, what is your long-term strategy? Is it to hit X number of dollars? Is it to hit total number of users? Is it to hit a certain percentage in margin and keep it consistent? Because each strategy, even the three I just listed, um, would represent a different way of growing the company. If it's revenue focused, then you might put the margin on the back burner. You might have a huge uh, expense just to float that revenue and spend a lot on like sales and marketing to bring in that revenue, but your margins are going to be lower. If it's to keep margins, and if you're a solopreneur, you're likely wanting to keep a nice take home income at the end of the day, and you want to keep that margin consistent because you want consistently to know how much you're going to be able to take home. And uh, so being able to figure out what you want growth wise and uh, what metrics you want to focus on to get to those points is really important. But again, this is an iterative approach. Um, so the way I listed it is cash flow comes first, then margins, then revenue, then growth targets. Because if you want to look at it as a foundation, it all comes down to, at the end of the day, cash flow. If you can't pay your bills, if you can't pay yourself or your vendors, then none of these matters, right? So once you have cash flow, then you can look at margins and figure out where to tweak things a little bit more and how to widen the funnel and grow your piece of the pie. Then it's revenue, figuring out how do you keeping it consistent, how do you maybe capture more from your customers, how do you add more value and charge for more, and then last, uh, looking longer term, where do you want to go, how do you want to hit that, if you want to stay smaller and just increase how much revenue and how much margin you are, but you just want to stay as a solopreneur, have no employees, then we can go back to 2 and 3 and really iterate off that. If you want to grow the business into having a couple employees or scale up even faster and higher, then you got to look at how do you plan for all of these other things and hold them in balance. So, in a nutshell, these are kind of the things I look for whenever I look at any business model and I work with any client. And these are really the first telltale signs of whether a business is healthy or not. I hope you found this useful. And yeah, if you liked it, please hit subscribe and join the journey. If you have any questions or comments and you want to see other topics talked about, feel free to leave a comment below. Have a great day and talk to you later. See ya. Being a solopreneur is a rewarding experience. You get to work on something you truly care about and on your own hours. But how do you know if you're on the right track? That's why I built Runway. Runway is an app that will score your business model. It'll also make recommendations on how to improve your score based on your industry's benchmark. Best of all, it's free to use. Just head over to runway.app or use the link in the video description and let us know what you think in the comments.